Hello, this is your daily dose of financial market trends. When the Treasury Secretary starts contradicting the Federal Reserve, markets get nervous fast. That policy clash is front and center this morning, alongside a major trade war escalation with Canada. Heading into today's session, yesterday's close showed a cautiously positive picture. The S&P 500 finished Tuesday at 7,677, up 0.3%. The Nasdaq gained 0.2% to close at 26,151, while the Dow added 0.3 to reach 53,577. The VIX ticked up slightly to 15.68, and the 10-year Treasury yield pulled back over 1% to 4.64%. Let's dive into what's moving markets. Broadcom is catching attention from multiple angles this morning, posting a modest decline yesterday while facing headwinds from intensifying competition in China's flash memory space. The semiconductor giant reports earnings next week on September 2nd, and investors are watching closely to see how management addresses both the competitive landscape and demand signals from the AI infrastructure build-out. With chip stocks showing mixed action lately, this earnings call could set the tone for the sector heading into fall. Meta Platforms rallied nearly 2% yesterday and is generating significant buzz across social channels and geopolitical analysis. The company is benefiting from broader themes around AI investment going global, with infrastructure spending expanding beyond U.S. borders. As other tech giants face questions about return on their massive AI capital expenditures, Meta's positioning in both social platforms and AI development is drawing fresh interest from investors trying to identify which mega-cap tech names can sustain their valuations. Alphabet slipped 0.3% yesterday while drawing attention for its exposure to financing risks in the NVIDIA AI infrastructure ecosystem. There's growing conversation about whether the current pace of AI spending is sustainable, and Google's dual role as both a major cloud provider and a significant capital spender on AI infrastructure puts it right in the middle of that debate. Any cracks in financing availability for AI buildouts would hit the search and cloud giant from multiple directions. The Nasdaq 100 ETF, QQQ, gained over 0.6 yesterday and is seeing heightened interest as the Treasury-Fed policy conflict creates uncertainty around the rate outlook. Tech sensitivity to both policy coordination and long-term rates makes this ETF a key barometer for how investors are positioning amid institutional friction in Washington. When the policy framework gets murky, watching where money flows in and out of broad tech exposure tells you a lot about risk appetite. 3 macro scenarios are shaping risk calculations right now. First, the Treasury-Federal Reserve policy conflict. Treasury Secretary Bessent is pursuing bond market interventions that appear to contradict Fed independence on monetary policy, raising serious questions about inflation control credibility. The bull case, given a 35% probability, says if these two institutions establish clear boundaries and Treasury scales back its direct market operations, bond markets stabilize as Fed credibility is preserved, benefiting both financials and tech growth stocks. The bear case at 45% is more concerning. If Treasury keeps intervening against Fed signals, institutional credibility erodes, inflation expectations rise, and volatility spikes across all risk assets as policy chaos takes hold. Second, U.S.-Canada trade tensions just escalated dramatically. Canada announced $20 billion in retaliatory tariffs, and the diplomatic breakdown has officials on both sides expressing real concern. The bull scenario at 30% likelihood envisions emergency negotiations leading to tariff pauses or phased reductions, which would stabilize North American supply chains and boost manufacturers. The bear case at 55% is that tariffs stay in place beyond third quarter, causing serious supply chain disruptions, surging input costs, rising recession probability, and collapsing cross-border trade volumes that hammer industrials and consumer goods. Third, the UK energy price crisis is intensifying. Household energy bills just hit 3-year highs, with another 4% increase coming in October. The bull case at 25% says if global gas supplies increase, or the UK locks in favorable long-term import agreements, consumer spending power improves and supports economic growth. But the 60% bear scenario warns that if prices stay elevated through the coming winter, consumer spending contracts sharply, pushing the UK toward recession and creating a stagflation dilemma for the Bank of England. On housing, 30-year mortgage rates are sitting at 6.65%, up over a full percentage point from last year. Housing starts have dropped over 13%, while building permits actually rose 3%, creating a gap that suggests builders have permits but are hesitant to start construction. That hesitation reflects uncertainty about whether buyers will show up at these rate levels. For earnings this week, keep Broadcom on your radar. The chipmaker reports September 2nd, and guidance on AI infrastructure demand will be critical for the entire semiconductor sector. 5 things worth watching from here. First, policy coordination risk is real right now. When Treasury and Fed send conflicting signals, it creates uncertainty that shows up in volatility and rate expectations. Second, trade escalation with Canada isn't just headlines. $20 billion in tariffs will have real supply chain and inflation implications for North American manufacturers. Third, tech is splitting between AI infrastructure winners and companies facing questions about capital efficiency and financing sustainability. Fourth, housing remains frozen between elevated rates and stubborn pricing, with that builder permit backlog telling you they're not confident enough to break ground. And fifth, energy prices in Europe are climbing again, which matters for global growth and inflation dynamics heading into winter. This isn't financial advice, just context to help you process what's moving markets. Stay focused on the signal, not the noise. That's your Morning Market Digest for Wednesday, August 26th. Remember, this is education, not investment advice. We'll see you tomorrow morning with the next update.